You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got my friend Devin Crane, who is the co-founder of Breaking Equity Strategies. Devin, it is awesome to have you here.
Yeah, thank you very much for having me, Sri. I really appreciate it.
Absolutely, Devin. And, to start, tell the audience a little bit about your background, how you got interested in finance and sort of your journey to founding Breaking Equity Strategies, because it's in a way unconventional because you don't have the conventional type of finance background. So
no, I'm definitely disconnected from the traditional finance path and building tools like this. But I think it's kind of nice because I'm bringing a fresh perspective of it. So how I came about the idea for Breaking Equity. Let's see. So I started my career off like building simple automations, and I've been working in AI and ML for the last, I want to say about 10 years, just working with software and figuring out how to solve problems and automate them and where you can build efficiencies. And then this application came out. You may have heard of it, called Robinhood. And they sort of opened up trading in my eyes, because you didn't really need, the $25,000 to open up a brokerage account or the $5,000 to open up one of those accounts. And it was really, really interesting to me. And I got deep into trading because I was always really sort of aware of stocks and bonds, like Wolf of Wall Street. And then the movie Wall Street with Michael Douglas came out, and like that seemed super interesting because these guys were dealing with a lot of money, and like this is a new world, super exciting. And when Robinhood came out, I got deep into trading. Like I got really deep. I read as many books as I could. I started learning about technical analysis and fundamental analysis and sentiment analysis. And I joined all these chat rooms. And I started reading all these forums, and like I found Wall Street bets early, like real early. So you could say I'm almost a degen in that respect. But I saw this, and then as I started reading more and learning more about markets, and started getting into Ray Dalio and Bridgewater, like what I found is that they're just applying systems to the market and then automating those systems or repeating those systems, but just manually. And then I was like, okay, how do I participate in a firm like Renaissance or Bridgewater or the Magellan Fund? And I was like, oh man, you have to have a lot of money to participate. I'm not one of those guys, but I'm pretty smart, and I figured it out. And meanwhile, my co-founder Michael and I, we had met and we were talking about trading, and like, what are you trading at work? And like, hey man, did you see Datadog today? Hey dude, I traded Tesla. What about Nvidia? AMD is a rocket ship, all this kind of stuff. And we're just sort of talking and like figuring out what sort of works in the market. And we both worked in automation and AI, and he's a pretty smart guy too. And finally we were talking around this idea of just automating our trades. And like he had subscribed to some like Motley Fool newsletter, and some other newsletters, and we were like, it would be amazing if we could build our own platform to automate our trades. And we're both sort of systems oriented thinkers, and we were like, you know what, let's just build an MVP and see if it works, like a minimally viable product, and see if we can actually build something like this, if we could like cobble something together. And we did, and it worked. And it was like when it worked the
Phenomenal.
first day, we were like, oh man, this could be something good. You know that feeling like when you put out good work and you're just like, oh,
This is good.
this
Yeah,
is
it's a nice sense of achievement that you get.
yeah. And then we kind of evolved from there, and we built Breaking Equity, and it works. You can build your own ETFs and trade them automatically on the broker of your choice. You can screen for the right opportunities. You can trade all types of equities, and we have a lot of big plans coming in the near future for what we're trying to do. But we're on like our third iteration now, and don't have any plans to stop. So we want to keep going.
Absolutely. And you founded this, in September 2020. So, back in the depths of the pandemic.
Yeah.
What is interesting is, your Breaking Equity has over 3,000 users. So before we go further, could you sort of explain, okay, what does Breaking Equity do, and
Yeah.
why should people be using it?
Great question. So this gets into, why should people automate their trades, and why should people look at automating trading, look at automated trading as a way to trade as part of their portfolio. We're not saying like go out and just invest everything you have in automated trades. Rather, we're saying like use a portion of your portfolio, to invest in this active type of movement, and we really think that's part of it. But why would you do something like this? So the reason we came up with this was because when we were working our full-time jobs, we would hop on a call, and we would be talking to one another, and we didn't have the opportunity to take a look at the charts or find the right entry opportunities. And like every single day, there's some sort of time arbitrage, not a real arbitrage, but there's some sort of inefficiency in the market. And what automated trading does is gives you the power to find those opportunities, because while you as an individual are limited in the amount of scope that you can see and find in charts and things like that, and what you're looking at, and what data is being presented, computers have that power to do this for you. And this is what we're employing, and we're building strategies around this that people can employ. And one of the strategies that we have is like, it's one of the ones that people love, is the inverse Jim Cramer ETF that we've built. And like, no disrespect to Jim Cramer, but he's a lightning rod and he's out there. But people watch his show at 6 o'clock, and then he gives a list of what he's holding and what he's selling and all this type of stuff. And we automate that for you, so you can go and do that. And you can automate newsletters. Like another one is we've automated Reddit sentiment, so you don't actually have to go through and read everything that's going on in Reddit, but you can actually automatically trade on your behalf with a specific type of strategy. So this is the type of power and things that you can do with our platform, compared to just looking at your phone, going to your broker, clicking the right option or the right equity or whatever, buy, sell at limit prices. Computers can do this so much faster. And then on top of that, the order management system that you're using, so the backend system, oftentimes trades will register before you're even able to figure out what exactly is happening, and then start managing the position for you. And then one of the most vital aspects of automated trading is managing your risk in trading. So the number one rule of trading is don't lose money, or preserve your money as much as possible, right?
Yeah.
It's kind of a big rule. And what I found is oftentimes when you trade, you get emotionally invested in what's going on. And there's so many other data points around you that you're looking at, that automated trading does this for you in an active sense. So if you're distracted for 1 second, you can still manage your risk. If you miss an opportunity, automated trading finds that risk. And this is what we're really trying to do.
And when you say, for example, you've got the inverse Jim Cramer strategy. So are these strategies constructed by Breaking Equity, or are they constructed by other traders, and they post them on Breaking Equity, and you can go ahead
That's a
and
really good question. That's a really good question. So we're building a marketplace for people to effectively exchange ideas and strategies. We've built sort of this we built this community aspect of how people can formulate trades and the way that they should construct them and the way that they should think about trading. And we are building sort of the initial models for how to construct these ETFs and construct the marketplace. But people are actually posting their own and creating their own strategies and then making them available. And we're working on this marketplace right now where people will be able to create their own strategies, and then you can actually stake against them. So you can use a token to stake against that strategy, and however the strategy is performing, you'll be able to trade with that strategy or not. And one of the differences that I kind of want to highlight in this respect is there's this concept of copy trading where you'll like sign up for a newsletter, you'll sign up for a chat room or a service. This isn't really copy trading, because you're not just following an individual, you're following a strategy, and you're following data, and you're following, L2 compared to someone just saying, oh, hey, I'm buying this or I'm doing this. And it provides that sort of like that data-driven mechanism to validate the process, and you have management over that data behind it.
Mm-hmm. And as you mentioned, so even if you have, say, for example, a chat room, but let's say an experienced seasoned trader, so if the trader places a trade at say 2 p.m. and you're at work or you're outside, or you don't have access to your broker dealer, you're gonna have a problem or like a lag by the time you place the trade. And so I guess you're solving that problem as well.
Yeah, that's really one of the components that we're trying to solve for, which is one of the things that most frustrated me, and I'll never forget it, but there was this opportunity with Amazon where they came out with a PR release. And or not Amazon, sorry, it was Netflix. And it was super telegraphed. But I missed the whole thing because I was on a call and I didn't have that chart up. And instead of having some sort of sentiment analysis to automate that trade, I totally missed it. And like, had I had a simple automation, like a very simple automation, I could have caught that whole profit margin. And that's also one of the rules in the game of trading, which is don't leave money on the table, right? Protect your risk, but make money when the opportunity is there.
Yeah. Yep. And if you go on the Breaking Equity website, broadly speaking, you've got two you've got in a way two products. One, you've got the marketplace, which I think you briefly discussed, and that's sort of where people create strategies and then start to try and sell them. And then the second thing is the Algo Lab, which is this is also interesting. So could you explain what exactly does the Algo Lab do, and also go into a little more detail on the marketplace? How does it work, and the monetization process when it comes to building and selling strategies?
Yeah, both good questions. So let me start with the Algo Lab. The Algo Lab is where you're able to first screen for opportunities, right? So how do you find the right opportunities, and what are the criteria that you're looking for? And you may be familiar with tools like FinViz or screeners within like TD Ameritrade, or there's dozens of tools out there setting alerts for price levels. And what the screen does is it builds weighted probabilities for the best types of entries and exits based upon that specific type of strategy. So in the Algo Lab, you can screen for those opportunities. Then you can build your strategy around the screen. And what I mean by building the strategy around the screen is, what are those criteria that you actually want to enter and exit trades, and how do you manage that risk? Do you have a trailing loss? Do you have a total number of trades that you want to make against it? Then you analyze the data in the lab, and it basically presents the data for like the win-loss ratios. What's the maximum drawdown? Is it profitable compared to a buy and hold strategy? Because dollar cost averaging and buy and hold are obviously viable strategies, and something that should be part of your portfolio. And then you can actually paper trade it. So the lab allows you to take your hypothesis and build a thesis around it, and then actually paper trade to find out how it's doing in the existing market. And one of the interesting concepts around the lab is, even in existing scenarios, you're always able to evolve these strategies, right? Because the market is never consistent. So you have to have like different strategies for different types of market environments that you want running to perform in certain environments. And like the last 6 months has been a bear environment, right? Or bear market, where your shorting strategies would be super successful and your long strategies may not. But how do you actually test those, and how do you create those types of strategies and the screens for them and the way that they operate? And then you can launch them live.
Got it. And so what kind of strategies can actually be tested using the Algo lab? So for example, if someone wanted to test, say, a basic, say an RSI divergence, would that be possible? What are the more advanced strategies that can be tested on the platform? And, how is it different from other back testers?
Yeah, that's great. So what you'll see is a lot of back testers, or a lot of like automated trading solutions, they really solve for like drag and drop and very, very simplistic strategies, very transparently. And there's this differentiation where you'll see.
So you were talking about, where I think we got cut out there. So you were talking about, how breaking equities back tester is different from other ones. So
yeah, so one of the ways that we're slightly different is a lot of the strategy builders that you see out there are, drag and drop, very limited variables, not exactly defining the risk management portion. They don't integrate both how you find the trade, the probabilities of those trades, and then the actual strategy component. We provide the extensibility and flexibility with which people can create more complex strategies, right? The strategies that actually can be well defined within certain market environments. So, an RSI divergence is a very easy one, but we have individuals who like actively trade. If XPX is up and RTY is down, find these 3 types of stocks, whether going, triple levered long, triple levered short, whatever it may be, and create a strategy based on that. So we're able to take the juxtaposition in the marketplace of the correlations between stocks and the juxtapositions, or like the trading pairs, or, the divergence within these, and actually apply automated trading behind them. So the lab is really like this environment where you can really put together these more complex strategies, but it's not creating the full spectrum of what people consider as algo trading. Like, we provide the framework with which you can do this in a overly simplified fashion.
And so, for example, if someone trades with Interactive Brokers or TD Ameritrade or Robinhood, does breaking equity automatically connect with?
Yeah. So one of the key tenets is we want to go to where traders are, and we want to provide the information for where the everyday individual is most familiar, because trading is hard, so we want to make it as easy as possible for people to understand, hook up their brokers, and really get going with this as quickly as possible.
Got it. One more thing about the backtesters. So typically, when people think about backtesting strategies, so excluding the automated backtesters that you can find on the web, usually people resort to executing some kind of code on Python, etc. And usually the learning curve to learn how to code is steep. Now, you can obviously, if you wanted to just test, say, a moving average crossover strategy, you can typically find the code on GitHub or somewhere on someone's blog, and you can almost just always copy paste it. But when it comes to breaking equities backtesters, so one, in terms of code, is it code intense, and if so, what kind of code does it actually use?
So we use in the lab right now, we're using Python. So it's, Python is this, I think, the second most common development language, and growing more year after year than any other development language possible. So we're using common libraries. We have a very active support network, and people are actually helping each other develop these strategies as they're actually developing them. And you don't need to actually go and copy and paste from GitHub and create your own infrastructure. Everything's self-encapsulated, meaning it's no longer setting up pandas to hook up the API to your broker and OAuth in via the servers you had to stand up on AWS. This is literally just that self-encapsulated IDE, integrated development environment where you're able to just sort of build and test. And the data is institutional grade. So that's also a net benefit where you don't have to pay for your monthly subscription of data that can range from like $49 a month upwards of $1,000 a month, and for an individual, that's just not feasible to pay for all of these things. And this is actually one of the things that we think is a differentiator, which is, right now it's cost prohibitive as an individual, both from a time perspective and a financial perspective to do this, right? The reason we started building this was because, we thought about building an algorithm for ourselves, and the amount of time it would take us to build something valuable was going to be a year long. Right. And we spent 2 years in developing a platform to enable people to do this in minutes. Right. And it's all about developing something meaningful and something valuable, and really just finding better trading outcomes.
Yep. And so when it comes to the products, so you said you have institutional grade data, and obviously a lot of people within the finance industry typically rely on, say, their Bloomberg terminal, which is obviously super expensive for the average individual. So if you
Yeah.
but I'm curious. So when it comes to the kind of products that you can backtest against, so is it mostly just stocks, or can you say look at FX, commodities, etc.?
Right now it's equities, and we're looking to move towards crypto as sort of the next asset offering available. And the reason that we want to move towards crypto is because there's really two infrastructures. There's what I consider old infrastructure, which is equities, options, futures, commodities, and a new infrastructure in the financial markets, which is crypto. And we want to bring these two worlds together. And we feel like a platform like ours that is able to handle automated investing as part of your portfolio, a very easy constructive way to do this. Where you're actually able to see the parallels between these two. Like, one of the things I've been doing is looking at crypto markets to understand how futures are going to play, and vice versa. If RTY is taking off the morning of, is futures going to follow, which could be a good indicator for the crypto markets as well. And so these are the types of things that, as an individual, it becomes really, really hard to manage all of these different components. But a platform like ours, I think, enables people to explore these types of opportunities.
And also, the other broad thing is, crypto is also rising in popularity. And in a way, within the crypto industry, you sort of know there's, in a way, two kinds of people. So, one kind is sort of the computer scientists, they tend to, code up strategies, create DAOs, create new infrastructure, and then on the other hand, you've got people like who just hodl Bitcoin and say and make economic arguments. So in a way, you've got both. In a way, you're really able to capture that kind of growth when it comes to when it comes to using crypto. So.
Yeah, and one of the things that you kind of mentioned is that there's, data scientists and crypto is sort of this new revolution for people, accessing trading or accessing financial markets. the types of investors that we firmly believe will be investing over the long run is, this younger generation who are more actively involved in active investing. This hustle culture. There was a great article by Andreessen Horowitz, I want to say a couple months ago, about active investing versus passive investing, and how active investing is going to become part of the definition of someone's portfolio. And we firmly believe that, like, Gen Y, Gen Z, millennials will participate in doing this. And Sri, I know you're in college. I know you're financially savvy. I know you have a financial podcast. You're well aware of what's going on in the markets, and this is going to be that definition going forward, where you got to manage your money.
Mm-hmm.
And we want to even the playing field. We want to democratize this to everyone. And I'll finish on this last point for this one, but it's not unreasonable in my mind that you'll have financial analysts in the future making their strategies and making their theses available to everyone. So you don't have to be an LP at an investment firm. You can find the advisor, the investment analyst, the principal, whoever it may be, posting these strategies available to you, and you can actually subscribe to them, which again, providing data-driven responses, or providing, historical information around those strategies.
Mm-hmm. Yep. Yeah. And you made that point where you talked about how you mentioned the A16Z article about active versus passive investing, and how active investing or active trading is going to play a larger role within people's portfolios. Recently, you've sort of seen the rise of movements like the FIRE movement, the financial independence, retire early movement, which usually, and these type of movements typically, or all the various accounts on Instagram, Twitter, etc., that talk about financial literacy, they typically tend to advocate for an investment for an investment plan that involves dollar cost averaging into various index funds, various index ETFs, etc., which is obviously passive investing. And so, do you think that trend is going to change? Do you think that eventually the norm is going to shift towards more active strategies, simply because that's sort of breaking equity's goal? You're heavily reliant on a lot of people using these active trading strategies.
Yeah. So one, I think dollar cost averaging should never go away, right? This is a tried true investment. Warren Buffett and Charlie Munger are where they are because they bought and hold for a long period of time. I don't think that passive investing, let's call it passive investing, should ever go away. I think active investing will become part of the more normal definition. Because if you participate in an ETF, you almost have, if you participate in one of these larger ETFs that are not necessarily active, that do quarterly rebalancing, that by definition is a good thing, because you're providing stability and you're diversifying your risk, right? Which is principle of financial management. But what we're saying is, if you take 10% of your portfolio and you have a higher risk tolerance and a higher risk management, you can potentially increase your risk to reward and your gains. And you mentioned dollar cost averaging, and I'll just throw this anecdote out there, which is, we actually built a strategy that we've been testing internally to Breaking Equity, which is dollar cost average on dips. And what I mean by that is, dollar cost averaging basically means you invest periodically, regardless of whatever the price may be.
Mm-hmm.
And we've built a strategy where over time, you basically accumulate money in a fund in your account. And instead of just doing this periodically, you'll wait for some percentage drop and then invest. And what we found is that actually outperforms standard dollar cost averaging, and you know, outperforms dollar cost averaging and buy and hold, because it's
Wow.
looking for those time opportunities, as opposed to just saying every 1st and 15th invest $50. And this is kind of what I mean by active investing compared to passive investing. Obviously, you don't want to do this with your entire portfolio or your entire savings account, but an extra 5% compounded annually is a significant change in total returns.
Mm-hmm. Got it. Yeah, and I believe I read that when I was going through your blog. Your blog has a lot of interesting studies. So one that's obvious, the one that's interesting is the one on how most of the returns for the S&P 500 tend to happen overnight rather than actually during market hours, and the fact that a lot of these traders tend to underperform coin flips, and so I think that was very interesting to read.
Yeah, I mean, it's one of the things that we're really we call it the Algo Lab, because we really try and take a scientific approach to how we're doing these things. So what ends up happening is Michael and I will basically be talking, and coming up with different types of strategies based upon what we read, whether it's like a CNBC article or an Economist article or like Wall Street Journal, and be like, hey man, what about the price of oil compared to SPX and then in the tech market, and see if there's some sort of opportunity there. Or like, Tesla earnings was yesterday and it's just on fire today, but we're saying like, does this have an impact on the rest of the electric vehicle market?
Uh-huh.
And what is that? And can we find potentially cheaper entry and exit points compared to buying a share of Tesla against the strategy? So like we really just try and find ways to construct systems around what we're doing.
Mm-hmm. Yep. No, broad problem when it comes to quantitative trading is that some information, may or may not be quantitative. So for example, there is I guess a rule of thumb. So, if you see, so if you're long wheat and, the Economist cover is talking about a coming food crisis, sell your wheat position, which is, or if you're like long tech and, Barron's front page is full of, why tech is going to change the future, that's your opportunity to sell tech. And so, but these sort of strategies can, while they're a nice rule of thumb and they're obviously comical, it becomes very hard to quantify and test these kind of strategies. So, is there something that breaking equities is doing in order to solve that sort of a problem? And two, if it is, if it is, or if someone wants to do something about it, how would you actually go about quantifying or trying to look at something that's not directly quantifiable, like a magazine headline?
Yeah, so we're still pretty early in our development phases, but all of the founders have AI and ML backgrounds, which again is kind of counter to, we don't have the traditional finance background. What we have is, sentiment analysis and artificial intelligence and building automated systems. So we definitely know how to access this data and then turn it into, physical data points, and then actually converting that. And this was one of the things that, Ray Dalio was so big on in building Bridgewater and his automated trading strategies, which is, everything can be turned into a data point for how to evaluate something. And, even sensory inputs for how we're actually evaluating these things can be turned into data points. So this is kind of where we think the market's going to head to, right? Like, there are a number of services out there that do like PR releases and sentiment analysis against those PR releases. You can run that type of data. You could do this for news. You could do this for 10Ks. You could do this for congressional filings. These are just data points with which you can trade against. So that's another ETF that we've built, which is congressional trades and following specific traders. Nancy Pelosi seems to,
Yeah, the
you know,
Nvidia, the chip when the chip bill was going out. So
that's the one that most recently came out, and she like, good on her, solid investment. I know the CHIPS Act is coming out soon too, but um, like if you want to follow Berkshire Hathaway's investments, why not build an automated strategy to do that when you don't have the funds to buy a share of Berkshire? And I know fractional shares are a thing, but like you could do this in your own portfolio without paying for the fees. That's the beauty of what we're trying to do. Like imagine your own ETFs without paying fees.
hmm Yep. And so in a way you can sort of, so if you look at, so there are various ETFs that tend to be actively managed, and so the firm that I work for, Simplify, we're trying to innovate within the actively managed ETF world. And when it comes to so when you say building your own ETF, so could you expand a little bit more on that? So do you mean being able to set up a portfolio that follows a set of rules or mandate that you've previously set up, or what
Yes.
exactly do you mean?
Yeah, so you can build automations, automated trading strategies, to effectively automate your portfolio every day to do like automated rebalancing or follow these strategies that these people are using. Like Kathy Wood is another one, right? Who has a basket of stocks that she invests in as part of ARC, which is effectively an ETF, right?
Yeah.
And you could build your own. Say you don't like a specific stock in that portfolio. I'll just, nothing against Exxon, but let's just say you are more in favor of green energy and you don't want to participate in Exxon. You can build your own ETF around green energy and exclude Exxon as part of that. Again, not providing any sort of direction here, but this is what's possible. And you're no longer dictated to do these things or subscribe to these strategies. You're able to build your own. And if you have ideas, you can do this. And if someone else comes up with a type of ETF that you're a fan of, or a strategy that you're a fan of, you can subscribe to those strategies and ensure that they're working.
Got it. And so really what you're doing is, in a way, you're trying to figure out, okay, what is this person doing? What is Kathy Wood doing, or what is Warren Buffett doing? And then trying to build a portfolio just based around basically what they're doing. So
Yeah, and it's really, I may be a little biased here, but it works. I employ this myself as part of my own portfolio, and I genuinely think this is the next evolution of how retail will work in terms of, first you bought a stock, then you bought a couple stocks, then you participated in an ETF, then you participated in robo-advisors and automated rebalancing. Then you participated in a number of, buying stocks on Robinhood because financial democratization became a thing. Then you participated in the options. Really, the next evolution is how to automate these things.
Yep. And so could you sort of explain, why is now the time for AI, or why is now the time to implement these automated strategies when it comes to trading or investing?
Yeah, the time is now because we're making it available, right? So the greatest barriers of entry, again, are time, money, and access, and knowledge on top of that. Like, how do you actually trade? Right, because trading again is hard, and I've been trading for upwards of 10 years now, and I still consider myself an active learner. And some days I do well, and some days I get spanked. So it just kind of happens that way. But if you can build systems and have the access, and you have the data, and you have the ability to do these things now, why not participate? Because hedge funds are doing this every single day. They're automating their trades. We're now leveling the playing field that you get to do the same types of things that these guys are. and it's available. It's here. So
Good to go. Yeah.
that's why, like, I think it'd be silly if you're actively trading to not automate your trades, because it just does everything for you.
Mm-hmm. Yep. When you look at the evolution of how computer science or how automation has entered trading, so if you go all the way back to the 1980s or 1990s, that's when Renaissance and their medallion fund became a thing, and you saw other shops, you saw um, Stevie Cohen, you saw Two Sigma Investments, etc. So and so from there, as you mentioned, if we jump all the way to the 2010s, we saw robo advisors become a thing, like Acons, for example, etc. We saw after that, as you mentioned, Robinhood became very big, because it really democratized the way finance functioned. And now, we're seeing breaking equity strategies start to democratize, the implementation of AI and automation within trading strategies. So, what was that? In your view, where do we, what comes next?
After I implemented like active trading, that's a great question. I mean, I still think the horizon, if you will, for people becoming more accessible, the in the know people, the creators of systems, is going to be significantly accelerated. But this is where I think the market environment is going to go, where you don't need the $250,000 to become an LP. You'll have these people who have ideas, who know what they're doing, accessible to people. And I think that's really where it's going to go. And you'll see the next thing that I honestly think will happen in the market is the markets become open 24/7 globally. And you'll see sort of this like globalization movement because of, crypto is active 24/7. You're seeing CBOE making SPX futures, SPX and futures open, on a daily basis, nearly 24/7. This is kind of where I think it'll go, just because there's so much activity in where the market's headed right now.
Yep. And so when it comes to going back to breaking equity, so one broad thing when it comes to testing out these strategies is thinking through one, in sample versus out of sample testing, and that tends to be a crucial part of general statistical analysis. So is this how possible is that just within breaking equity and so when it comes to once again when it comes to breaking equities backtester, so how easy is it to use, and how when it comes to say the UX and the UI, so do you need to have the technical knowledge, etc., in order to be able to use it?
So one, you don't need technical knowledge to automate your trades anymore. It's totally available. Two, we actually built our multiple engines, to like development engines and backtesting engines, so that you could actually run your strategies in a simulated environment, in a live simulated environment, on different exchanges and through different brokers. So you can actually see parallels between execution against broker A, execution against broker B, and our own breaking equity engine, right? So you can actually see the variations there, and the entries, exits, what does slippage look like? What is the time frame between order created versus order executed? Like, everything is recorded and available. And it's done just via a click, like click launch your strategy. And you can go from not having any automated strategies to launching your automated strategy in a matter of, I think it's 5 clicks right now, and we're even trying to make it easier. So like your RSI, like the RSI example that you brought up, I think it's a great strategy. I have an awesome screen that runs against it right now. I would recommend playing around with one of those, but you can launch that within 5 clicks. in breaking equity in a simulated environment and live environment. So totally available.
Yep. That's fantastic, man. With that, Devin, I wanted to wrap up the podcast, before you go. So one, where can they find, where can they find Breaking Equity? And, are there any places to follow Breaking Equity on, say, social media, etc.? And
yeah, I really appreciate that question. Available on breakingequity.com. We're actually posting the best strategies of the day on Twitter right now at Breaking Equity. We come out with blog posts and we email those to subscribers and to registrants. We actually have a very active Discord with a great group of traders who more seem to join all the time. And I know that there are some big traders in there. So yeah, like we're pretty excited about where the future lies for us.
Yep. Absolutely. That's fantastic, Devin. Thank you so much for being on the podcast. It was awesome
Yeah,
talking to you.
Sri, thank you so much. I appreciate it.